A warm welcome to Market Pulse by SC Securities and Daily FT. I'm Dilusha Gamage. And today I'm in conversation with Mr. Mahesh Udugampala, the Head of Research of Softlogic Stockbrokers. Mahesh, welcome to Market Pulse.
Thank you for having me.
Mahesh, at the moment we are going through a very uncertain time and the investor community is quite worried. So what is the way forward from now onwards for the investors as per your view?
So if you look at the market has taken a beating over the last couple of weeks and probably will come down over the next couple of weeks as well. We will be seeing some volatility over the next month or so. Right now what we can see is that the unprecedented hike in interest rates is weighing on the market. And a lot of investors are now looking at which kind of asset allocation is suitable right now. In my opinion, I would say, yes, interest rates are offering you decent returns, but one would argue that as inflation is high, you are actually looking at a negative real interest rate. But in case if you can lock in at a higher interest rate of 18 or 20+% for the next 3 or 5 years, probably in the first year you will have negative real returns, but going forward from the second year onwards, you will have positive real interest rates. But saying that, if investor is looking at a higher risk appetite and a higher return, I would say still the equity markets are very attractive. And the valuations are trading at a very low multiple. If you look at the crash during COVID, I think certain counters and certain sectors are trading even below that. So it's very cheap right now. And if you are looking at the market, I would say you need to take a medium to long-term view and invest accordingly. If you are looking at short-term returns, I would say treasury bills or government securities would be the option. But if you are looking at a better return, I think this is a good entry point into equity markets.
And also, Mahesh, as you correctly touched upon, this is not the first time the market going through a drop. And there are cycles that we have been experiencing this. And even in different cycles, different companies have been performing. And according to your view, can you elaborate in the cycle that we are experiencing at the moment? How will that work on, and what would be the companies that would perform well in this cycle?
So if you go back to the last 2 years, let me call it the first cycle. Just after the COVID lockdowns, what we saw was certain companies which were exposed to PPE, personal protective equipment, they did well. You saw DIBT and companies like HECAB doing extremely well. And then you move, and then their earnings kind of died down. And then you moved into the second cycle, where interest rates were low, there was high liquidity in the market, and for investors there were not much of options to invest in because the interest rates were really low. And we saw freight rates rising, and there were companies that did extremely well during that period. For example, construction companies, material companies, and particularly retail construction related material companies did extremely well. That's because when interest rates came down, a lot of people borrowed and started building houses and started engaging in retail construction. But now the third cycle that we are in, I would call this as we are in an intermediate state where we are moving from the second cycle to the third cycle, where we see higher interest rates and lower liquidity. The central bank has taken steps to reduce liquidity in the market, in the economy. So there is altogether going to be a different set of companies that are going to do well. And those companies would be companies, obviously the companies that are engaged in exporting goods and services, and also we are kind of bullish on certain conglomerates that have exposure to tourism as plus real estate, because the replacement cost of real estate has gone up by 3 to 4 times. And also right now, although we have seen a certain improvement in tourism arrivals over the last couple of months, we have seen a slight slowdown with the whole economic and political concerns we are experiencing right now. But if we are looking at a recovery cycle going forward, if we see some improvement in the forthcoming quarters, we might see tourism also as one of the sectors that could do well. So we are bullish on those sectors, and I need to mention that certain construction and construction related material companies might not do as well as what they did in the last few quarters. Basically because now the interest rates are high, and we might not see major retail construction coming into play. And also the prices of raw materials have gone up significantly, and the purchasing power of people have come down. And we are expecting certain amount of taxation in the coming months, and with that the disposable income of people might come down, which is going to weigh on the construction side as well as on the consumer side to a certain extent. So it's going to be a set of companies, a different set of companies that is going to perform well. Financial services is also a sector that could do well. But right now we are having a neutral view on the financial sector or the banking sector. One reason is because of their exposure to ISBs and SLDBs. Right now, the government is engaging in negotiations with the lenders as to what kind of restructuring mechanism they are looking at. But right now, why we are having a neutral stance is basically because we don't know what kind of restructuring is going to happen, whether it's going to be a haircut or whether it's going to be a maturity extension or a coupon adjustment. And even if it's a haircut, we don't know whether it's going to be 10% or whether it's going to be 40% or 50%, which we have seen in some of the countries that have gone through the same cycle. So probably within the next 2 months, next 3 or 4 months, I would say we might have some clarity as to what kind of restructuring will be decided on the ISBs, and that's the time we need to relook at the banking sector, is what I feel.
And also, Mahesh, now the interest rates hike. This is a major factor when it comes to asset allocation. So now it's no doubt that interest rates have gone up. So from now onwards, so what's the way forward? Will it continue the trend, or what's your take on the interest rates in the future?
All right. I think this 700 basis point increase was unprecedented, and no one expected this, but this much of a rate hike. But going forward, what we feel is probably if you look at a country like Argentina or a similar country which has gone through this kind of a cycle, both politically and economically, I would say interest rates tend to move up, and then it becomes a bit volatile. There is a period where there is a bit of volatility, and then it slightly tapers down. So I think that's the phenomena we are looking at right now in Sri Lanka, because now as interest rates have moved up significantly, we are going to see a major impact on the growth aspect. But right now, for the central bank or for the government, the important thing is to maintain stability. They need to maintain stability in terms of interest rates and the exchange rate. So right now, the growth is secondary, but when we see things improving, it's not going to be overnight, it will take some time, but when we see things improving, the central bank has to look at the growth aspects as well. And at that point in time, they will look at stimulating growth. And right now, because of the IMF program and the conditions that they have stipulated, we don't have much power in order to give fiscal stimulus. So the only stimulus that could improve growth would be through the monetary policy, and that would be the interest rate tool that they might use. So when we see things stabilizing, when we see these reforms happening, and when we see SOEs getting restructured, and when we see signs of the IMF coming into play, we might see the central bank taking steps to bring down interest rates to stimulate the economy. So probably, to summarize, it might move up further, and there will be a volatility period, and it might come down. And need to keep in mind, we have seen the interest rate cycles getting shorter and shorter over the last couple of decades. And this time, with this significant spike, I think it's going to be much shorter, is what I believe.
Okay, and Mahesh, so considering all these factors, what is your final message to the investors? What would you recommend, and what is your advice to them?
The advice would be, if you are looking at equity, equity can give you good returns. Obviously, there are risks with these unprecedented events happening in the economy. And we have seen in other countries which has gone through similar cycles, the equity markets running. But for that to happen, we need to see some announcements coming in. We need to see IMF bailout package getting realized. We need to see certain reforms being implemented. So that positive news needs to come in. So probably in the short run, we might see certain amount of volatility. But in the long run, if you invest, I can say that there will be good returns that would beat fixed income returns, is what my belief.
And thank you very much, Mahesh. Thank you for joining with us and also sharing your valuable insights with us. Ladies and gentlemen, you are listening to Mr. Mahesh Udugampala, the Head of Research of Softlogic Stockbrokers, and you are with Market Pulse, and this is Mr. Mahesh Udugampala, and we are concluding the discussion from this. Thank you for watching.